Ray Dalio is a billionaire investor who made his fame during the 2008 Great Recession. His hedge fund, Bridgewater Associates, posted impressive gains in the years to follow, outperforming most other hedge funds and the S&P 500 benchmark index as well. Many investors are now looking to Dalio to see what his thoughts are on a 2020 recession possibility, and here's what he had to say about that.
A recession, is 2 negative quarters of GDP, and we're going to be hovering, I think, fairly close to that level, and there's a certain variation around it. But the bigger things are a combination of the absence of effectiveness of central bank policies, so I hope we can talk about those, together with the wealth gap, the large wealth gap. So when the next downturn comes, what that will look like socially, politically, and so on. The elections, which is a issue between, let's say, capitalists and socialists, or the rich and the poor, and then the emergence of China and in relationship to the United States. Those 4 factors are factors that have not existed since the 30s. I think they're unique. And so when we get into the question of the recession, I think it's how that will affect those other things, and those things affect it.
Now, you're in the investment world, your firm was well known for quite some time before the last recession. It was a very successful firm before, but in the last recession, your firm performed extremely well, maybe better than any other major hedge fund. So, as I recall, you're up 28% or something like that during the worst year. So, are you anticipating a recession now, and are you changing your investment approaches, or you're not quite where you were in 2007?
In 2007, it was pretty easy, I think, to calculate that there were these debts that were going to come due, and that there was not an adequate amount of funding. And so that sort of debt crisis was something we anticipated and we were positioned well for. When I go through those calculations, it's not the same. In other words, the amount of maturing debt and that whole problem doesn't look the same. It looks more like a gradual squeeze having to do with quite a lot of debt of a certain type. But with that, also pension liabilities and health care, particularly as that produces a greater squeeze. We have large deficits and so on. So the amount of promises that we have are large, but they're going to be coming at us at a more gradual pace, and I think that's going to produce a squeeze. I think related to that, what's important is that when you don't have monetary policy being able to be effective, what kind of monetary policy we will have? We will have, more than likely, a lot of debt monetization.